If you build a combustion engine, you quickly run into a physical limit, the second law of thermodynamics. No matter how you engineer the system, some energy always disperses. It is physically impossible to translate 100% of fuel into useful work. We can apply that exact same physics constraint to financial capital markets. For a market, the raw fuel is complex fundamental information about cash flows and discount rates. The output, the useful work, is an asset's price settling at an unbiased reflection of its fair value. In 1965, the economist Eugene Fama proposed the strict definition of an efficient market, a system where prices instantaneously and fully reflect all available information. But just as a perfectly efficient machine cannot exist in reality, neither can a perfectly efficient market. If markets instantly priced all information perfectly, the entire system would freeze. There would be absolutely no incentive to analyze data, because no participant could ever extract a profit. This creates a structural catch-22, known as the Grossman-Stiglitz paradox, formulated by Sanford Grossman and Joseph Stiglitz in 1980. They proved that the sheer cost of acquiring information mathematically guarantees a degree of market inefficiency. Gathering fundamental data, modeling complex outcomes, and projecting cash flows requires immense resources. It is incredibly expensive, difficult work. Active investors will only incur those costs if they can extract proportionate compensation. They demand risk-adjusted access returns, or alpha, to justify participating. Lasse Petterson calls this efficiently inefficient. It's a feedback loop balancing the cost of gathering information against the extraction of excess returns. The market reaches an equilibrium, sustaining the active arbitrageurs who correct mispricings. To extract sustainable alpha today, you have to look beyond the mathematical mispricing itself. You must identify the precise mechanical or behavioral inefficiency that is actively driving that specific gap. The baseline assumption of asset pricing is straightforward. A company's fundamental value is its expected future cash flows, discounted at an appropriate rate. Standard models often assume equity returns follow a normal distribution, a bell curve. The reality of the market is extreme positive skew. Finance professor Hendrik Bessenbinder conducted a comprehensive empirical study of 28,600 U.S. public companies listed over the past century. He found that 59% of all public stocks actually destroyed wealth over their lifetimes when compared to holding simple one-month treasury bills. The upside is heavily concentrated. A mere 2% of stocks generated over 90% of the total aggregate wealth created in the entire market. The reliable upward trajectory of the micro market masks an underlying reality of overwhelming corporate failure. This distribution forces institutional investors to carefully manage the severe risk of single stock exposure. We see the same pattern when we move away from historical stock returns and measure fundamental corporate earnings, as shown in a major study by accounting professors Sanjeev Bojraj, Ashish Ochani, and Shiva Rajgopal. They measured the ratio of a company's remaining lifetime earnings to its initial stock price. This chart tracks that ratio across 13,800 public firms trading between 1975 and 2019, splitting into two stark extremes. Looking at the bottom cluster, 71% of all analyzed firms failed to generate enough lifetime earnings to justify their initial stock price. The median ratio for the total sample sits at just 0.2. That means half of all companies produced lifetime earnings worth less than 20% of their initial market valuation. This fundamental skew confirms that blindly buying and holding concentrated equity positions is a statistically asymmetrical wager against the active investor. The math favors the house. If mispricings and long-term wealth destruction are so mathematically common, why don't arbitrageurs immediately step in and short these stocks to close the gap? The answer lies in the real-world friction of execution. Identifying a mispricing is only the first step. You then face short borrow fees, tax implications, and severe financing risks while you wait for the trade to play out. Arbitrage attempts to pull a diverging asset price back to its fundamental value, but prices only incorporate information up to the exact point where the marginal benefit of acting exceeds the marginal cost of the trade. The economist Paul Samuelson articulated this dynamic clearly. He argued that the stock market, exhibits micro-efficiency, where individual stocks are relatively accurately priced against one another, alongside macro-inefficiency, where the overall market can drift far from its fundamental anchors. This creates a critical distinction between the idea that prices are right, meaning they are unbiased estimates on average, and the reality that there is no free lunch. Mispricings routinely exist, but they cannot always be profitably exploited. A massive gap between price and value is economically irrelevant if the mechanical costs and carrying risks of making the trade destroy your expected return. This brings us to the structural evolution of the participants themselves. When you execute a trade, you have to understand who is actually on the other side. Classical finance assumed that demand curves for stocks were perfectly flat, that you could trade any volume without moving the price. The data proves otherwise. Equity demand curves slope downward based on clustered directional buying and selling. Between 2006 and 2025, $3.2 trillion drained out of active mutual funds and poured into passive index funds. These passive, rules-based strategies now control more than 1/3 of the entire U.S. public equity market. These passive funds operate mechanically, trading strictly on index inclusions and mandate parameters. Their capital allocation is entirely divorced from fundamental corporate valuation. They spend zero resources on price discovery. Instead, they free ride on the analytical work and liquidity provided by the remaining active managers in the system. The dominant and growing force in modern equity markets now trades entirely on structural flow mandates rather than fundamental reality, creating massive flow-driven blind spots. Every day, the market processes a systemic collision. A massive, blind index rebalance order enters the market, and an active manager calculates the arbitrage spread required to take the other side and provide liquidity. Despite heavy capital outflows, active managers continue to provide the critical foundational public goods of price discovery and liquidity that passive index funds absolutely require to exist, and the data validates their analytical skill. Historically, institutional active managers generate a positive gross alpha, averaging 67 basis points, proving clear stock selection capability before fee extraction. For the modern active investor, traditional market analysis is no longer enough. You must identify misvalued companies while simultaneously navigating the gaps left by forced liquidations, index rebalancing, and correlated crowd behavior. This leaves us with the core duality of the framework. An active investor absolutely requires market inefficiency to execute a mispriced trade at entry, yet that same investor relies entirely on the relentless eventual efficiency of the market to correct that price over time and realize the profit. Alpha is found in the calculated friction between structural flow and fundamental value.